All right. If you look at your program, you'll notice that this is the session that is standing between you and refreshments. So, among other reasons, I'm going to try to keep us on track. We have two speakers. Our topic is housing and housing finance. And as was brought out by Andy Lowe's comments earlier today, we've got lots of narratives, but one narrative that doesn't go away is that there were issues about housing finance. And so we've got two speakers today to address that. Each of you have 20 minutes. I'm going to sit down there, and if you see me waving my hand, I'll put up 5, I'll put up 3. You're all witnesses to this, and we'll try to get you all out to refreshments on time. We've got our two speakers, Chris Foote, who is a senior economist and advisor, a policy advisor at the Federal Reserve Bank of Boston, and we've got Antoinette Shore, who's the Michael M. Kroner Professor of Finance and Entrepreneurship at the MIT Sloan School of Management. And so Chris is going to start. Chris, you've got 20 minutes. I'm going to be tough, and take it away.
Okay, thanks very much. So the most important, I want to also point out this is a joint paper with Paul Willen, who is seated safely in the back row in the back and can help me answer any difficult questions. It's very important, though, that I point out that as Paul and I are both employees of the Federal Reserve Bank of Boston, these views on mortgage default and other things are our own views. They do not represent, well, they may, but they do not necessarily represent the views of our boss, Eric Rosengren, or the big boss, Jay Powell. So it is not surprising that the editors of the ARFE for 2018 would want a paper on mortgage default, because we certainly saw, as you all know, a large increase in mortgage defaults during the recent recession. 90-day defaults, 90-day delinquencies, which typically do not move very much in recessions, rose with a vengeance in the most recent recession. And a natural question that economists have is, why were there so many defaults? But when you frame the question in that way, you're really asking, why did we have a recession that was so closely tied to the housing cycle? Why did we have a housing cycle to begin with? And there are common explanations for that. We'll talk more about them later. Were there a lot of unaffordable loans that were originated that later went bad? Were there distorted beliefs or over-optimistic beliefs about housing prices that encouraged lenders to make a lot of loans that went bad? That's actually not the right way to frame this issue, to frame this question, if you're standing from the vantage point of a mortgage default researcher. If you're coming at it and ask, what influence does this green line, these increase in defaults, have on the mortgage default literature? There, the right question is really why we had so few defaults. And by few defaults, I mean so few defaults conditional on the collapse of housing prices that we saw before and during the Great Recession. So on the left panel, the blue and red lines show you HPA, house price appreciation, the rate of change in housing prices over time. That typically declines in recessions, but it declined with a vengeance in the most recent recession. On the right, you see the fraction of homes, according to CoreLogic, that had negative equity or near negative equity. LTV ratios of 100%, equal to or greater than 100%, or greater than or equal to 95%. And if you can't see the numbers, in 2009, we had about a quarter to a third of mortgaged households in the United States that owed more on their homes than their homes were worth, that had negative equity. And as you know, negative equity is typically a precursor of default, but a third or a quarter of mortgages in the United States did not default. The number of defaults was much, much lower than that, as you saw in the previous graph. Now, theoretically, as it turns out, the benchmark model that we use in the mortgage default literature, the frictionless option model, is qualitatively consistent with the fact that a lot of borrowers with negative equity do not default. And this model, which has been developed over the last several decades, comes out of applying standard option pricing techniques to the borrower's default decision. Now, the graph I have up here is from the paper. We're very proud of this graph and the MATLAB program that generated it. I'm not going to go through it in detail, mainly because I don't really want to explain option pricing when Robert Merton is sitting in the front row. But for my purposes, it's enough to really give you the intuition of what this frictionless option model is all about. Now, it starts with the assumption, as you might guess, of frictionless capital markets. Someone who has a mortgage can also freely borrow and lend outside of that mortgage arrangement at the risk-free rate. There's no limits to short and long positions, and we sort of have the common treatment of stochastic processes for house prices and interest rates. They're volatile, but there's a no arbitrage condition that sort of pins them down. Now, what's the implication of this setup? Well, the implication is that once borrowers get a little bit of negative equity, if housing prices fall a little bit below the value of their mortgage, they don't instantly default. Why? Because there's an option value of waiting to see if the housing prices recover. And default only occurs when the amount of negative equity reaches some level that's so deep that in a precise sense, it's really not worth continuing making the payments in the hope that the price will go back up again. Now, in 2008, along with Chris Girardi and Paul Willen, the three of us wrote a paper that used Massachusetts data from the early 1990s, which had gone through a house price decline at that time, to show that we could actually measure using deed registry data how many mortgage borrowers in Massachusetts had negative equity, and we showed that over time, only about 10% of those homeowners lost their homes. So we were, score one for the frictionless option model. We also sort of wrote down a simple two-period model to express some of this intuition. Now, that's not the end of the story, though, because problems come when you move from qualitative statements generated by the FOM about default to quantitative statements. What happens when you actually calibrate the frictionless option model with a reasonable variance of housing prices? How big is that region of negative equity where people aren't going to default? And I'm going to illustrate this with a graph here. So this is comparing the default function as generated by the FOM. I don't know if I can really point here, but as you move to the right into the blue region of the graph, you're moving to a higher LTV ratio, and once you pass 100%, you're in negative equity land. You don't default according to the FOM right at 100% negative equity. You default at some positive or some further value of negative equity. That's where it says FOM default threshold. But at that level, boom, your probability of default goes all the way up to 1, and at very high levels of negative equity, you default. Now, how big is that FOM default threshold with reasonable parameters? You're typically looking at something like 110% LTV, 115, 120. It's hard to get that to be 150. All right, so that's sort of how we think about things quantitatively. Now, the blue and the red lines there are sort of empirical default functions with borrowers of different types of credit scores. That's not so important, the difference between the blue and the red. The important point is that empirically, the default function looks like there's a lot of people who have very high levels of negative equity that are not defaulting. And in the literature, those are attributed to transactions costs. And transactions costs are to mortgage default researchers what dark matter is to astronomers, right? It's all the stuff we really can't quantify and really don't know about. It might be the stigma that you get from defaulting, the hit that you get from your credit score, having to move your kids into a new school. Whatever it is, it's a cost that depresses the empirical default function below what you would get from the FOM. That's problem number one. And we've known about these these transactions costs going way back to the 1980s. Nice paper in the Journal of Finance by Buddha shows that they're relevant for the current crisis as well. Another problem is that borrow level characteristics seem to matter for default. And I illustrate here with sort of characteristics of a borrower's credit score. But an easier way to think about it is think about a borrower who loses his or her job, or who gets divorced, or who gets sick, who suffers some sort of adverse life event that makes it hard for them to keep up with paying their mortgage. In the frictionless model, remember, those borrowers can borrow and lend freely, even outside their mortgage arrangement. So if the borrower loses the job, the borrower just borrows and takes a loan, and that's that. If the FOM says they should continue to pay, they continue to pay. In the real world, however, borrowing constraints limit the ability of borrowers or mortgage borrowers who face or suffer adverse life events from taking those types of loans. So what happens? Borrowers who suffer adverse life events often default. Now, when we think about the effect of adverse life events on default, we're led to sort of a different approach to thinking about default, and this is the famous double trigger model. So on the left panel there, you have a very simple or basic treatment of the double trigger model, which says default occurs when two triggers are pulled. First, the borrower has to be in the left column so that they have negative equity. Borrowers who have positive equity don't default. They just sell their house no matter what happens and pocket what's left over. The top row, though, the second trigger is the top row says the borrower also has to suffer an adverse life event. So both of those triggers get pulled. According to the double trigger model, the borrower is going to default. The other panel there, panel B, shows a more sophisticated or what we call the modified double trigger model. And in that model, you might think that there's a little bit of optimization going on, such that if you're in the upper right corner of that triangle, you've got low negative equity. You basically have almost positive equity. And so it's going to take a very big income shock for you to default. If you're in the other corner, you've got very deep negative equity, so it may take only a small adverse life event for you to default. And so when we start thinking about the modified double trigger model, what we're trying to do is really kind of blend ideas from the frictionless option model, which sort of really stresses negative and only negative equity, to adverse life events. And that really takes us to the, I'm going to actually skip this, that actually takes us to the research frontier. What are the papers in mortgage default that are appearing in journals trying to do today? Well, they're trying to write down models in which expectations about future house prices matter, as implied by the FOM. They may try to sort of adjust the way that expectations are formed so that they might be non-rational in some sense. They might sort of expect mean reversion. So what do I mean by that? Well, here are some graphs of house prices for the US as a whole and 3 of the so-called sand states. Arizona, Florida, Nevada, and California is not on there. So if you look at the upper right panel there, that's for Arizona, you see that Arizona had a big decline, but then there was a non-trivial recovery in prices after that. What would a borrower do if they were sitting in the trough and they sort of knew, really what happens after crashes is that the prices crash, but typically there's a period at which they are more likely to rise than to decline. They would therefore be more likely to hold on to their homes at any given level of negative equity. That would be consistent with what we find, is that that default is less prevalent than a pure frictionless option model would suggest. Third sort of thing that people are trying to do in these models is that they want to show that there are borrowing constraints, or at least allow for borrowing constraints, so that adverse life events matter, and that most borrowers are going to remain current on their loans even when negative equity is deep and or liquidity constraints bind because of these amorphous transactions costs that we don't know much about, but that we'd like to know more about. Now, that's sort of the whirlwind tour of kind of how the mortgage default research is now progressing given what we've sort of had in the crisis. I next want to talk about, before I leave that, I want to say that over time, the data to test this model is going to probably get even better. Most people working in the mortgage default literature empirically are using loan level data on millions of observations. Ideally, though, we'd like to have a data set that is large like that, but has information not on only how the mortgage is doing, but what else is going on in the borrower's life. It would be great to know, for example, on a month-by-month basis, how much income that borrower has. Not too many data sets like that, but some of those may come online later on. Okay, so the organizers of or the editors of the journal, I learned today that these papers are supposed to be reviews with attitude. We weren't told about the attitude part. We were just told about the review part. But I think the next section has a little bit of attitude in it, because what we do in the paper, in 3 areas of the paper, is talk about how lessons from the mortgage default literature could be very relevant for important questions related to policy in the financial or in the foreclosure crisis, and also relevant for sort of why the crisis happened to begin with. So one question is, should the government have written down mortgage principal more aggressively? And there's also ones about the patterns of defaults and the potential causality between foreclosures and house prices. So the first one was, there was a lot of debate about how the government should try to prevent foreclosures during the acute phase of the crisis, and specifically whether or not the government should try to reduce principal, mass write-downs of principal, or to focus on reducing the current monthly payment that borrowers have to pay. And what they eventually settled on with HAMP was really policies that were targeted mostly on the payment reduction side, not mass reductions of the principal that they borrowed. Now, we think that's a good idea because the key problem with principal reduction as an anti-foreclosure strategy is it really doesn't work that well no matter what type of default you're trying to prevent. So think about a double trigger default. The whole point about double trigger defaults, or the whole thing that sort of gets them into the model, are liquidity constraints. The idea that $1 today is worth a heck of a lot more than $1 later on. Well, what does a mass write-down of principal do? It basically means, hey, when you sell this house, you're going to get a lot more money in your pocket later on. And that doesn't help you too much in the present. And there's a great paper in the Brookings series by Eberle and Krishnamurthy which really draws this implication out. Well, what about principal reduction as a way of reducing just pure strategic defaults that would be implied by the frictionless option model, defaults that occur just because negative equity is very deep? Well, there the transactions costs come into play because the very low default rate among non-stressed borrowers, or borrowers that haven't lost their job or suffered any adverse life event, means that mass principal reductions aren't going to be cost effective in preventing those defaults. There might be a lot of people with negative equity, very deep levels of negative equity, but empirically, few of those people actually default. The data show in papers that are coming out now, one written by Paul and a co-author, Andreas Fuster, do show that payment reductions that that are sort of caused by, for example, interest rate resets. If your interest rate resets down such that your payment is reduced by a large amount, lo and behold, that has a very significant impact on your default frequency. However, as a matter of policy, the important thing to keep in mind is that any anti-foreclosure program is going to have an imperfect information problem. Everyone's going to want to say, yes, I can't pay my mortgage this month, I need a reduction, or yes, I've got negative equity, I'm going to default. But in reality, not everyone is actually going to default, and that makes things a little tricky. So the second question involves default patterns and the underwriting standards as the ultimate sort of cause of the crisis. So there were a number of early papers in the literature that used patterns of defaults among marginal borrowers to sort of point to this idea that the crisis resulted in large part from sort of an exogenous increase in bad underwriting through securitization or whatever. And we talk about these papers a lot and sort of discuss some alternative interpretations of their findings. I think now recent work is showing that the problems in the mortgage market were widespread throughout the income distribution, and certainly this is what Antoinette is going to talk about, and that there's a new narrative that links the housing cycle to distorted beliefs about asset pricing rather than securitization or bad underwriting. But a lot of this research that has sort of, in thinking about defaults, can kind of help us with this. In 2012, with Chris Girardi, we pointed out that if you look at the people we're talking about subprime defaults and the resets of subprime defaults to higher interest rates were causing a lot of defaults, we talk about how in the paper, 89% or 88% of people who ultimately defaulted did so paying the exact same payment they made at origination. And so if you look at the paper, you'll see a lot of discussion of defaults and the patterns of defaults and show how they may not be consistent with the conventional wisdom, but could be consistent with the story about beliefs. So finally, there's a lot of talk about the effect of foreclosures on house prices. Pretty much everything I've said up to now talks about how declining prices can lead to more foreclosures. Well, could there be causality going from a wave of foreclosures causing house prices to decline? And we have a long section, well, not too long, but a thorough treatment of that question in the paper. Now, it is true, and theoretically, foreclosures do reduce the set of potential home buyers. But unless those folks who get foreclosed on go live in caves, foreclosures also raise the set of potential renters, and therefore rents. And so therefore, with higher rents, that encourages landlords to go buy those homes and convert them to rentals and rent them out. Now, a key question here, and that is sort of having a dampening effect on any decline in prices that would come from the initial wave of foreclosures. Now, a key question here, and that's also relevant for a lot of other issues, is how separate the owner-occupied market and the rental markets really are. How easy is it to turn a house that is owned into a house that is rented and vice versa? But in any case, in the data, you will actually see when housing prices stabilized was precisely the time in which there were a lot of completed foreclosures going out on the market. So our view is that theoretically this is possible, that you may see foreclosures affect housing prices, but the existence of landlords and the data, landlords in theory and the data suggest this is not really a big channel. So the bottom lines of our paper, just as the Great Depression sort of stimulated macroeconomics, we think the Great Recession has very significantly stimulated research on mortgage default. The basic patterns, though, were consistent with what any default reacher would have told you circa 2002. If you're going to have a big increase in defaults after a house price collapse, that's not surprising. The vast majority of people with negative equity are not going to default, and as a result, that has big implications for policy to prevent foreclosures, making it difficult. Going forward, researchers are going to try to blend the FOM with the double trigger models, and here the treatment of price expectations is going to be critical. Do borrowers kind of have over-optimistic views either in the boom or after a big trough? And empirical work is really going to be helped by more big data coming online. I would want to say, though, that when you see a bunch of defaults going on, it is a feature of risk sharing in our economy. And we close our paper with a discussion of very important papers that say, under imperfect markets, if you can't specify outcomes for a mortgage payment at every point in time, given what's happening with a borrower, defaults may be the best way we have to share risk. And with that, I think I'm out of time.
Okay, fantastic. Cool. Thank you very much. What I want to talk about is the role of housing markets in the run-up to the crisis, and I want to exactly pick up where Chris left off to show you a set of results about housing market and mortgage markets in the run-up and the aftermath of the crisis that might actually, to some of you, be surprising given the narratives that we, in a way, have learned to believe about housing markets in the Great Recession. And all this work is joint work with Manuela Delino and Felipe Severino, who are my co-authors in a set of papers and also in an RFE paper that we wrote for this volume. Kind of what I want to pick up on is something that Chris said at the end, which is that the narrative about the crisis initially started off focusing on only focusing on distorted incentives in housing markets that then led to, a bunch of trigger-on effects. But what I want to show you today is a set of results, empirical results, that much more suggests that what we had at the core of the housing market was a classic housing bubble that then led, basically, or driven by rising house prices and over-optimistic beliefs, we saw that households increased borrowing, and households also increased just participation and buying in housing markets. But at the same time, banks also bought into these rising housing prices and expectations by lending against collateral, if you want, unabashedly. And in some sense seem to have underestimated the potential for reversal in house prices, and basically with it the defaults that then Chris was talking about. And before I show you the results, to me the big takeaway, or the big, in a way, misnomer of this crisis is that we're still calling it the subprime crisis, when what I will show you is actually this was a much wider crisis in the housing market, and in particular middle class and upper middle class borrowers were very much part of the credit expansion, and in particular the defaults afterwards. And this obviously matters, as we'll discuss at the end, because it affects how we want to think about policy implications and preventing these kind of crises going forward. So, in a way, the way I see this is that the financial sector acted as an amplification mechanism by lending into these increased house prices, which kind of picked up on the over-optimistic expectations. But what we do not find, and I'll show you now the data, is that there was somehow a unilateral shift or an unprecedented shift, say, of lending to just marginal or subprime borrowers. Again, right, there was an overarching shift. So the facts, kind of that we'll be looking at today is basically first focusing on the run-up to the financial crisis. What I'll show you is that credit expanded across the income distribution. It didn't just expand, say, for subprime or poor and marginal borrowers. In particular, I'll show you that middle and high-income households actually had much larger contributions to the run-up in the total dollar of mortgage debt before the crisis. And then I'll also show you that actually, those households afterwards defaulted at a very high level. But interestingly, what we'll also show you is that debt-to-income levels expanded proportionally across all types of borrowers: subprime and prime borrowers, low-income, high-income borrowers. Surprisingly, at the same time, we see that the loan-to-value distribution, the LTV distribution, actually stayed stable over that time period, meaning that we, in particular, the increase in the debt-to-income levels seem to have been fueled by lending against increased collateral values, but not a shift towards higher LTVs. And I'll show you this in a second. Now, on top of it, I'll also show you that there are that homeowners seem to have been buying and selling or flipping housing at a much higher rate in the run-up to the crisis. But surprisingly, we do not find, for example, that ownership rate increased. In fact, if anything, home ownership rates decreased even prior to the crisis, which is actually a result that it's quite surprising. But as I'll show you, it's heterogeneous between subprime and prime, or poorer and richer borrowers. And then, in the aftermath of the crisis, I will show you how there were sharp increases in delinquency rates, but the biggest increase in the dollar value of defaults actually came from the middle class and the upper middle class, who defaulted at an unprecedented rate. All right, so let's dive into the data. Ultimately, right, this is, as Chris also said, an empirical question. So the first thing, as I said, right, what I want to show you is in the run-up to the financial crisis, there was no dislocation of where credit was flowing, but what we see is that there was a symmetric increase, if you want, of homeowners participating in the housing market and in the mortgage market over that time period. So the first thing I'll show you, if you look from the left to the right, this is mortgage dollars originated by income quantile, right? The top is the highest income quantile, the bottom is the lowest income quantile, which we fixed as of 2000, right, and then held constant. And this is to show you that actually from 2002 till 2006, year by year, the distribution of mortgage dollars actually stayed constant, right? So if you look at this, right, the white white cells at the bottom, this would be typically probably your low-income subprime customers, but you see that there was not a disproportionate increase of credit flowing to these groups. No, instead we see that across the income distribution, people were participating and, of course, expanding borrowing over this time period. I can show you this also in a different, oops, why is it doing it? Okay, I can show you this in a different way. Rather than binning by income, I bin by FICO score. So this is what we typically would call subprime, right below 660, between 660 and 620, and the top graph here, and 720, and the top graph is above 720. And what you see again is that between 2000 and 2006, we actually see that the fraction of mortgage dollars flowing to subprime customers stayed constant, right? Of course, the mortgage market expanded. There was much more lending done, but the distribution across the different FICO bins actually stayed constant, right? So again, this is saying that there was not a disproportionate shift of where mortgage dollars were originated or where they were flowing. Another way of saying, again, right, is that everybody seemed to have been participating in that credit boom. All right, so of course, I already said, right, these graphs, while I'm saying they proportionately stay flat, we know that underneath it, total amount of dollar raised, right, or originated, increased. And how can I see this? There's two ways I can show you that. Number one is, so this is from the Survey of Consumer Finance. This is total mortgage dollar at the household level, including, people call it CLTV, right, including second liens and all mortgage dollars. So what you see is proportionately across all income quintiles, debt to income level at the household level increased, right? But it was, again, proportionate across all income levels. There was not a, disproportionate shift to, say, more marginal or subprime borrowers. Or another way of saying this, right, it seems everybody bought into this housing bubble and basically into the increased housing prices. Actually, surprisingly, just to show you, in a way, almost how mechanical people were borrowing is when you look at the loan-to-value distribution, right, the famous LTV, from the mid-1990s, and I'll show you this basically till 2012, what you see is that distribution actually stayed very flat, right? So this is saying that the fraction of households that had, say, a 95% LTV, a 90% LTV, right, an 80% LTV, these are, the bins here, right, again, stayed stable over that time period. Now, of course, I showed you that DTI went up. So what does this mean? What this means is that because the value of homes were going up, right, people were able to take on more credit against those now more valuable houses, therefore DTI went up, but the loan-to-value distribution, right, stayed stable, meaning that what banks did is they just almost, you could say, mechanically lent against these now higher house price values, right? Now, why I'm making such a big deal out of it, it's because that actually suggests that in some sense what went wrong here is really the expectations about how believable and how stable these house values are, and how banks should have treated them as collateral. And what this data shows you is that they basically believed what they saw and did not become, say, more cautious after seeing a huge run-up of prices in many areas. Yeah? All right, the final thing I want to show you, because in the run-up part, is lots of people then have said, okay, maybe the intensity, right, meaning the fraction of loans that people took on is, as you said, right, and is kind of this story. But what about the extensive margin, right? I'm sure many of you have heard this story that, oh, but what the banks really got wrong is they started to lend to more and more marginal borrowers. They kind of were digging in the garbage can, right, as people sometimes like to say, and get out basically loans that should have never been made. Actually, if you thought about if that was true, right, we should have actually seen an expansion of home ownership within the US over that pre-crisis period. But what this graph shows you is that this is exactly not the case. In fact, it's quite stunning. So what we do here is we plot for you changes in home ownership rates against, again, by these by these income bins that I showed you before, right? And blue here is the lowest income bin, red is the second to lowest, and then so on and so on. And what you see, and we normalize in 2000 by basically the rate of home ownership for each bin in 2000. Now, what do you see? What you see actually is that the fraction of home ownership in the lowest two income bins started going down already, in 2002, 2003, and then really accelerated, of course, after 2007, 2008, right? So this is to show you that actually it looks much more like many low-income households started being priced out of the housing market way before 2007, right? So it was not the case that the run-up to the financial crisis or the boom period of the 2000s afforded low-income and subprime people to enter home ownership at an unprecedented rate. If anything, right, these numbers show you that, yes, for richer people, there was an increase in home ownership, right? These are the top three graphs. But for poorer people, actually, it started already declining way before 2007. And then, as obviously this graph shows, very much accelerated post-2008. Great. So, I mentioned this. I want to skip over this quickly, right? What we also saw, and there's a large literature that is now, kind of coming back to this, is that the flipping or the speed at which houses were bought and sold leading up to 2008 increased dramatically. And so what this is showing you is kind of data from Zillow, the fraction of homes that were bought and sold within 12 months of a given year, right? And what you see is kind of leading, up from 1998, you see this big spike in the speed of churning, and then, of course, post-2008, right, the big drop-off. But this, again, right, is suggesting that households across the income distribution were participating in the housing market and with it in the mortgage market at a very high rate. All right, excellent. So this is, kind of the run-up. And in a way, I wanted to show you these results because they suggest that there was a widespread participation across income groups, across FICO scores, subprime and prime borrowers, and that in particular, right, it looks like even at the extensive margin in the run-up to the crisis, we didn't see an increase in participation, but we saw of say marginal homeowners, we saw a doubling up or kind of a more intensive participation of the middle class and the upper middle class. Now, a final piece of information I want to show you from the aftermath of the financial crisis is who defaulted. So Chris already showed you in, kind of in a really nice presentation, right? The type of trade-offs that people make when they consider life events and whether they're underwater or not, right, in the default decisions. I want to just show you one very simple thing that actually, Chris and Paul, for example, have also shown in their work, but didn't maybe come out as much, kind of in what he showed you, which is that house price movements mattered a lot in who defaulted. So the first thing I want to show you is just, cross-sectionally, who starts defaulting post-2008. The first bar I'm showing you here, very similar to what I showed you about, kind of origination dollars, is we take every cohort, say, the most left word here is 2003. So mortgages originated in 2003, sorted by whether they are subprime, meaning below 660, between 660, 720, and above 720, right? And then we follow them for 3 years and see what fraction defaults within the first 3 years. And we take 3 years because very often, right, the modal time period by which people who will default start defaulting is often 3 years. That's why we follow 3 years, but we can do the same for 5 years, 6 years. It would look exactly the same thing, right? But what the first bar here shows you is what you would normally have expected, right? Which is that most of the dollars mortgage dollars in default after 3 years come from the subprime group, right? Come from the white part of this bar. 70% of dollars in default are people with a FICO score below 660, and only 9% are people with a FICO score above 720. 720, which is exactly what should be the case when we have a functioning mortgage market, right? The people that are of good credit score default at a much lower rate than the people that kind of are low FICO score. But now fast forward, right, 3 years, and what do you see? So this is mortgages originated in 2006, which I now follow right till 2009. And what you see is that a big shift is happening. The mortgage dollars in default, right, increase the most in the medium and the prime segment, meaning in the group that is 660 to 720 and above 720, right? And you see that the white bars, so the below 660, are going down significantly, right, over that time period. So what's going on there, right? What's going on is actually that the default rates of the middle class and the upper middle class went up, and they went to unprecedented rates in the US, but the rate itself, right, the increase was significant, but the rate, of course, is not as high as subprime. Let me say this in a different way. So if you look at 2003, you would have had, even in normal times in the housing market, the subprime group might default at a rate of 6 or 7%, even when there was no housing crisis, right? That's why they have low FICO scores. But high FICO borrowers, in normal times, default basically at a 0 likelihood. But what happened post-2008 is that the high FICO borrowers are the ones that start defaulting after 2008. And as Chris was saying, right, it's a combination of being underwater and potentially having life events. But the important thing to note is that the high income and high FICO borrowers are the ones that have the big mortgages. So when they went from 0% default to 4 or 5%, that's when the market really got into trouble, right? And that's when we see these big increases of dollar in default of the high prime and medium prime customers, right? And that's the big shift that we hadn't seen before in that housing market. And then as a last thing, right, what we can do is cut or divide the sample by people who live in neighborhoods that saw a rapid increase in house prices and then a crash, versus those where there was not much of a difference. So on the left are the people that live in neighborhoods or zip codes where there was not as much as a price run up. And on the right are the part of the US where there was a big increase in prices and then a drop. And look, what you see is that the big increase in prime borrowers defaulting is exactly in the areas where prices went up and then crashed, right? Again, saying that house price movements not only played a huge role in who took on mortgage leverage and participation in the mortgage market, but also then who defaulted afterwards, right? So all this is to show you that house prices and house price expectations seem to have played a very important role in the run-up to the crisis, and then explaining also default behavior of mortgage participation or borrowers in the crisis. And why this is so important is that this actually suggests that the way we want to think about regulation in mortgage market is very much from a macroprudential perspective, right? This is not, these type of expectation shifts is not something we can regulate at a bank-by-bank basis or, you know, at a microprudential level, but we really have to think about this from a systemic perspective, as, you know, many of the speakers just in the panel before have also basically alluded to. Thank you very much.